Are you looking to make some absolutely fabulous investments in real estate investment trust into REITs? Today we are going to look at the office segment. Now this is a segment that is rapidly changing, and we're going to look at some of the key drivers and some of what is going on here. It's not all about simple work from home. It's not all about these companies are failing. There are some gems in here amongst all of the others, although this is the sector of the REIT companies that have really been under the most pressure lately, with the big price declines, some of which are justified. But as I say, stick with us. We're going to look at all of the options here in the office REITs, and we're also going to isolate those that give you the most chance for further investment research so that you can begin to find the best options to invest in today. So stick with me and we'll get into what to look for next. Okay, welcome back my friends. So look, lots of pain has been priced into the office REIT market. They have been by far the worst performing property sector since the start of the pandemic, for fairly obvious reasons. Who wants to be in the office? And of course we've been in lockdown. So look, work from home has been a big thing. We're going to look at some of the data here as well, and then we're going to be getting into look at some of the actual options here. Now, we also want to note that the supply growth isn't necessarily a big aid here either. There's also been very high vacancy rates, and that's also been given the tenants a lot of opportunity here for greater negotiation power, particularly in the more urban markets where there's been long commutes. We'll get into that next as well, because really I think it's the commutes here which are, the big problem. So how much pain? Well, there's been a lot of pain priced in, and we'll see that as we see the big price declines across the office REITs as well. Dividend yields are actually quite high now, 5, 6, and some even recording higher, closer to 10 or more percent dividend yields. But of course, one of the big questions for many of these is how sustainable is that going to be for these companies? So working from home research, for example, they cite that the commute is one of the biggest or the biggest benefit for working from home. We don't have to be stuck in a car. And this is an issue that isn't going to go away, and it's an issue that's going to be exacerbated, I think, in the larger urban markets also. Now, no commute is a big issue here, but also the flexible work schedule. Now, employers could do something about that even with a return to the office, but they probably can't do anything about spending less time getting ready for work, having more time with friends and family. They could do something about, working from home being more quiet. If you think about being stuck in a cubicle and open plan offices, these are actually manageable problems, some of these for an employer, but I don't think these are going to be anything that changes anytime soon. And so we've got a big issue here. People don't want to be stuck in a car, on a bus. They don't want to be stuck commuting. They don't want to be in the office. This isn't going to change. And talking with people, I had some students from New York University, they are very focused, really, I think, on the work from home. They don't see a return to the office, at least in their potential future careers in New York, is something where they're going to be stuck in the office 5 days a week. That isn't going to be their expectation moving forward. Now, I think what we'll see many employers actually responding to that, and we'll begin to see some softening of office leases. Now, JLL Office Outlook for Q4 2022. Leasing activity has fallen 10-11% over the quarter. Tenant preferences, there's been a big softening in the large-scale leases, and that's going to be a driver for many of the larger office REITs, I think, as well. Prices. Landlords have been able to actually preserve the rental rates overall, but there's also quite a small pipeline coming through a new supply, and that's also going to be quite a challenge here. In terms of, can you reduce prices further in terms of negotiation if you're a tenant? The answer is possibly not, because there's not a lot of other options coming online as well. Now, when we're talking about quality, we're talking about rents that are actually still continuing to increase over the last several years, but we're also seeing quite a change here in the other benefits to the tenants as well that are being offered on offered to them to really sweeten the deal. So for example, an increase the number of free months, as well as the TI allowance also increasing. Also here, limited groundbreakings are driving down the new supply pipeline, so we can see over the last couple of years quite a steady decrease here in the number of millions of square feet that are in the pipeline, and the new constructions are also down quite a bit over the last several years. Okay my friends, first off, Alexandra Real Estate Equities, ARE. So you can see here a history in the global financial crisis, quite a steep downturn in the AFFO as shown here on fast graphs. We can see that they've been selling at a premium in the last 5 or 6 years, quite a steep premium in fact, even after the pandemic, in fact soaring to very new highs, and then more reasonably priced now, down to the normalized price to earnings line of about 22 times AFFO. We can see a nice strong growth here in the dividend post GFC dips, and a BBB plus S&P credit rating. Long-term debt to capital looks very healthy at 35% roughly. And if we switch over to the forecasting calculator, if prices return to the normalized AFFO levels by the end of 2025, or do 2024 I think, simply because of the number of analysts reporting here as a larger number of analysts, we could see an annualized rate of return of close to 40%, so quite a good rate of return. Now one of the big questions is, are they likely to reach that level again? So if you look here at the AFFO forecasts, previously 6 months ago they were forecasting, analysts forecasted about $8.20 AFFO. That's decreased down to $7.87. We can sort of see similarly, there hasn't been such a big decrease in the 2023 AFFO forecasts, so that seems to be softening into the future, although the recent price dips over the last several weeks has provided, I think, a reasonable opportunity here. Now we can also see that the dividends are projected to increase at a reasonable rate. If I switch over to the performance tab as well, we can see that the dividend growth has been fairly steady at about 5% minimum dividend growth rate over the last several years. Now if you pair that with the current dividend yield of 3.8%, it looks like a reasonable time to buy. Now still on AFFO, Brandywine Realty Trust, BDN, going alphabetically through the office REITs. A dividend yield is an extremely high 14.53. Now the big question here is, can they maintain that? So following the GFC, a big crash in the AFFO, and it's been relatively constant since then. Now we can see as well that the white dividend payout line here in terms of AFFO seems to be quite elevated, so the dividend payout ratio seems elevated, particularly now at about 84% at the end of the 2022 financial year. Now this is BBB minus credit rated, and compared to the first option here, it has a higher long-term debt to capital ratio. Now one of the causes here for concern is the way in which the estimated payout in 2023 financial year is actually higher than the estimated AFFO, which is quite concerning. Now this is partly due to the projected decreases in AFFO in the last 3 months or so, projected to decrease quite substantially, and again similarly in the 2024 financial year as well. Now if they were able to hold their dividend payout ratio to the end of 2024, the current price decreases have actually led to a situation where if the AFFO estimate is correct, and prices return to a normalised level of about 13 times, you might see annualised total rate of return of about 60%. Although I've got a big question here personally looking at this, is whether or not this payout ratio is actually sustainable, or whether or not we'll see a dividend cut from the company in coming years, during this coming year. Generally as well, 1 and 2 year estimates seem to be fairly good by the analysts, and so that also again just makes me wary and cautious about the opportunities in this company. Boston Properties, so this is always sold at quite a steep premium here. The blue line is quite elevated at 28 times price to AFFO ratio, and we can see prices have decreased quite substantially in the last little while here. Now that's led to a dividend yield of about 6%. Now the dividend payout, or the dividend growth, sorry, has been stable. They haven't grown the dividend at all in the last couple of years, and so that doesn't bode well for a long-term dividend growth investor. So if you take to the end of the 2024 financial year, again prices have declined quite substantially. If prices return to the 27 times price to AFFO ratio, we're looking at a total annualized return of about 70%. Now again, as we've seen with the other REITs so far, we've seen quite a softening of the AFFO projections over the 6-month period, and again for the 2023 financial year, quite a softening. Now the dividend looks like it's set to remain relatively stable with a small increase in 2024, and if AFFO increases, that actually should improve their payout ratio in the next several years to about 75%, so a more stable level. They're BBB plus rated with quite a reasonably elevated long-term debt to capital ratio of about 64%, and quite a reasonable analyst scorecard here for 1 year forward. 2-year forward estimates tend to be hitting 75% of the time, which is not actually as stable as I would personally like to see. So the next REIT, City Office, again big premium here in 2022, and prices have collapsed quite a bit. The analyst scorecard here with a relatively less history isn't looking quite so good, with some pretty severe misses here, pretty much 2/3 to 3/4 of the time here, 1 and 2 years out. Now they have seen choppy dividend growth with some dividend cuts as well as the dividend increase in 2022. And probably the big question here is, well, what are the future prospects going forward? Well, we can see they've got a 10% dividend yield now, no S&P credit rating, about a 43%, which isn't bad, long-term to debt capital ratio. Looking here till the end of 2024, we're talking about a 30% annualized rate of return. Now again, quite a softening of AFFO projections during the last 6 months. And one of my big concerns here is the dividend payout currently is quite high relative to the AFFO levels per share. So we're talking about a dividend payout ratio here of 119%. So again, this is something I'd be looking at quite closely to see whether or not there is likely to be a dividend cut. I don't believe at this level that it's going to be very sustainable. Okay. Creative Media and Community Trust Corp. So not much going on here. Dividend yield 7.6%, reasonable long-term debt to capital ratio. Not a lot of analysts following this REIT. In fact, to the point of it being fairly worrisome in terms of the normalised AFFO predictions, etc. So we're just going to skip over this REIT. Next up we have Cousins Properties. Now you can see quite a choppy price range here, as well as quite a choppy blue and orange line here for the AFFO projections. The long-term debt to capital ratio is about 34%, which looks good. Dividend yield of about 5.8%. Analysts have done a reasonably good job, although it looks like it's a fairly difficult one to estimate. The dividend has been growing at about 3% in the last several years, and if prices return to their regular AFFO, price to AFFO ratio, we're talking about potentially a 34% annualized rate of return till the end of 2024. And again, like in the other cases, we've seen some fairly reasonable softening here of the AFFO estimates out. The payout ratio would be a reasonably healthy 73% based on AFFO levels to the end of 2024 if these prices are maintained. Easterly Government Properties. So since the 2020 level, we've seen a steady decrease in the prices. 7.5% dividend yield, 49% long-term debt to capital. Analyst scorecard has been reasonable. They're not beating, but they tend to hit the forecast more times than not. And if prices can return to the AFFO levels and ratios by the end of 2024, you're talking about potentially a 26% annualized rate of return. Again, AFFO projections have been depressed, and we can see from this white line above the blue line as well that we're looking at quite an elevated dividend payout ratio if dividends are maintained at this level, which they're estimated to be maintained at this level, and the AFFO dips down, as we can see here, projections of a 17% decrease in 2023. We're talking about, I think, the risk of the company paying out more than they're collecting, so a dividend payout ratio of over 100%, something to be careful about. Emmett Douglas, DEI. So we can see here a very steady price increase, very steady AFFO increases, and very steady dividend increases up until recently. 2 billion market cap, 67% long-term debt to capital ratio, healthy 6% dividend yield. Analysts tend to do a very good job of estimating this company's AFFO. Forward estimates, they hit 83% of the time for 1 year. 2-year forward estimates, they hit 92% of the time. Now, the dividend increases have been fairly strong up until 2022 year with an 8% dividend cut, and then the big question is what's going on here? Well, we can see here, looking forward in the estimates in the forecasting calculator, we can see that AFFO is projected to decrease 6% in the 2023 year, hold reasonably steady in the 2024 year. If prices can return to a 21 times price to earn AFFO ratio, we're talking about a 77% annualized rate of return, or 182% to the end of 2024. Now, at the same time as well, what we've seen is quite a softening in both 2023 and 2024 of the AFFO levels, and of course we've seen that decrease in the dividend. Now, what that has done is it's put the forward dividend payout ratios at a very healthy estimated 50% roughly in 2023 and 2024. So you can sort of say, I think that the dividend looks like it's going to be a lot safer moving forward based on this level. But I don't think that prices are going to reach that 21 times. So I think there's a reasonable opportunity here for a 15 times price to earnings ratio, price to AFFO ratio, sorry, which would be about a 50% gain, total annualized rate of return from this point. Equity Commonwealth has some decreases here in AFFO. It's not rated. And I think what we're seeing here is not worth worrying about, so we'll just skip over this one. So this is just a list of all of the office lists, office listed REITs on fast graphs. So Franklin Street Properties, again decreasing AFFO to the point of not really worth worrying about. Highwoods Property Trust is an interesting one, which I know is quite popular. So again, we can see price action over the last 10 years has been quite elevated relative to reasonably steady AFFO levels. Current dividend yield 8.5%, BBB rated, reasonable long-term debt to capital levels. The analysts do a reasonable job. 2 years forward estimates of about 75% in the estimates of AFFO. 1 year forward estimates have been a bit more dicey, where they're getting it wrong half the time. If we're looking at the normalized price to AFFO ratio of about 20 times, we're looking at the forward estimates here to the end of 2024. If prices return to this price to AFFO ratio of about 20 times, you're talking about a 60% annualized rate of return. Now again, we've seen reasonably, I think actually less softening than in many of the other office REITs here of the AFFO projections, so reasonably stable here, which is always positive to see. The dividends estimated to be held relatively constant, with a small increase here in 2024. Looking at a reasonably healthy dividend payout level here in 2024 of 76%. So I think some reasonably good opportunities here in Highwood Properties. Hudson Pacific Properties. So we see a very, very, very steep decline here in prices. BBB minus rated, long-term debt to capital ratio of about 56%, and a current dividend yield of 12.5%. Now, the analysts have done a reasonable job, I think, here in the 1 year forward. The company beats analyst estimates about a third of the time. hits them a third of the time and misses a third of the time. 2-year forward though is not great actually. It's only 55% hit and a 10% beat on analyst expectations for AFFO, which is a little bit, it's not really a great track record there, I think. So if we look at the analyst estimates going forward, if prices can return to the regular 24 times price to AFFO ratio by the end of 2024, we're talking about an annualized rate of return of 122%. Now, we've seen, again, like many of the other office REITs here, quite a softening of the AFFO projections. We've also seen 2022 to 2023 a 12% decrease in the AFFO projected levels. The dividend payout ratio here is estimated to be about 75 to 80% in the next couple of years, holding that dividend steady and static at about $1 per share, coupled with the decreases here in the AFFO ratio. Now, the price declines here are quite extreme, taking it down to a price to AFFO ratio of about 6.4 now. So quite a low level, in fact even below 6.4 now, down to the 5s, 5 to 6, hence if it can return to an elevated 24 times price to AFFO ratio level, I think that's probably quite an extreme case. If we look down here at some of these other options, I think here a more reasonable option might be a return here to a sort of a 15 times price to AFFO ratio almost, with an annualized total rate of return of about 70% per year here. I think that might be achievable in this particular case, but I would want to dig into this in a bit more detail and really see what's been driving this decrease here in the prices in the last year or so. JBG Smith Properties. So not a lot of history here. 1.7 billion, 42% long-term debt to capital ratio, 5.8% dividend yield. Analysts don't have a huge lot of data here to work with, but they've not really done a very good job of estimating the AFFO 1 year forward. Slightly better on the 2 year forward case, but not a lot of data to work with. So if we switch over to the forecasting calculator, only 2 analysts are providing estimates going forward. So if we take the 2024 estimates, we're talking about an annualized rate of return here of nearly 50%. But again, what we're seeing, I think, here is quite a high elevated dividend payout ratio here of about 93%, 94% in 2023 year, and actually an over dividend payout ratio estimated of over 100% here 2024. Now that's assuming that these dividend raises come through and the AFFO softens as much as the analysts expect. So I think here they're flying pretty close to the line here, but if they can see a return to a more reasonable price to AFFO ratio, I think, down here probably only 14%. So I think actually here they're really, I think, at a 14 times price to AFFO ratio, given the growth that they've seen, it's probably not too bad. If they return to a price to AFFO ratio of about 18.8, we're talking only about a 15% annualized rate of return. So not, I think, huge opportunities in this option. Kilroy Realty. So big price declines here over the last couple of years, BBB rated, reasonable long-term debt to capital ratio of 44%, about a 7% total dividend yield. We can sort of see a reasonable growth here in dividends, and a reasonable growth here in AFFO up until recent years, with a bit of a projected softening. Now, the analyst estimates have been a reasonable 1 year out, and about hitting the analyst estimates about 2/3 of the time for the 2 year out estimate. Switching over to the forecasting calculator, taking it to the end of 2024 with 7 analysts providing estimates, we're talking about a total annualized rate of return of 79%. That's largely driven by this very steep decline here in prices in the last year or so. We see a softening here of the AFFO into 2023 of about 11%, with some small gains here in 2024 expected. Like the other options, we can see some softening here in the 2024 year for the AFFO levels, but holding reasonably steady in the terms of the estimates here in the 2023 year. The dividend increases are projected to continue at a relatively small rate as compared compared to some of the other options, which is quite good. And we're looking at an estimated dividend payout ratio of about 2/3 in 2023 and 2024. Now, is it likely to get back to 25 times? Probably not. But if we take some other options here down to, say, even at 20 times, we're still talking about potentially a 59% total annualized rate of return here, the Kilroy reality, going to a reasonable, if prices can return to a reasonable price to AFFO ratio of 20 times. Corporate Office Properties Trust, OFC. So not a lot really happening here in terms of prices or AFFO over the last decade. BBB minus credit rating, 56% elevated, I think, long-term debt to capital, 4.7% dividend yield. Now the analysts have done a reasonable job of estimating this, so it's a fairly stable, static, reasonably easy to estimate company here. So I think we can probably take their forecasts as reasonably accurate, and in fact we can see that prices here are hugging that 16-17 times price to AFFO level. We can see actually an increase here in AFFO in 2023 and a smaller increase in 2024, and AFFO estimates have been softening a bit for the 2024 estimates over the last 6 months. The analysts have sort of revised those downwards a bit, both in 2023 and 2024. But if prices can hold steady here into the 2024 year, if prices remain at this level and AFFO estimates remain accurate, then we're talking about potentially an 18 times total annualized rate of return, with a dividend yield here that's lower than what it was in 2023. Dividend payments are lower than 2023, but a healthier estimated dividend payout as a result. Orion Office, so this is a spin-off from the monthly dividend company from O. Not a lot of price action here because it's a recent spin-off. Long-term debt to capital ratio appears to be healthy. Dividend yield of about 6%. I did sell my shares soon after they were spun off. So we don't obviously have a lot of analyst estimates here to work on. And we don't have a lot of analysts following it, but the one analyst following it does suggest rather weak or rather steep decline here in AFFO into the 2023, and then another steep decline here into 2024. So not one that I'm going to spend a lot of time on here. Office Properties Income Trust. Again, AFFO has been steadily decreasing, as have prices. So even though the dividend yield looks pretty nice at 15.8 times, I don't think it's going to stay at that level for long. BBB minus credit rated, quite an elevated 57% long-term debt to capital ratio. Analyst scorecard here is actually quite reasonable, so the analysts do a reasonable job of forecasting what the AFFO levels are going to be 1 and 2 years out. If we look at the analyst estimates, we can see again this blue line here is representing a steady decrease in AFFO, an estimated 24% drop in 2023 and another 15% drop in 2024. So we're talking potentially, because prices are so low now, if prices remain at this 7 times AFFO ratio, and these analyst estimates for AFFO are correct, we're talking about a meager 7.6% total annualized rate of return, which is not particularly good, and there's only one analyst following, so again take this with a big grain of salt here. But I think the history is showing us that those steady AFFO decreases are probably not going to be our friend. Piedmont Office Realty Trust, so some jagged changes here in AFFO, but quite a steady price decrease here in the last year or so. BBB rated, reasonable long-term debt to capital ratio, and a current dividend yield of 10%. Analysts do a 50% of the time they get it right, and 1 year forward, a quarter of the time the company beats their estimates. So a quarter of the time the analysts have got it quite wrong. 2 years out, they do a reasonable job. They miss the estimates about 1/4 of the time, but the rest of the time they usually bang on roughly, or the company beats those estimates a small amount of the time. Now, what does this actually mean? So if prices return to a roughly 15 times normalized price to earning AFFO ratio, and prices rise to meet those AFFO projections, by the end of 2024, you're talking about an annualized rate of return of 50%. Now again, softening AFFO levels in 2024, less so in 2023. The dividends are estimated to be held constant. There's only 3 analysts following, so take this with a grain of salt. But that would mean that the dividend payout ratio was 60% in 2022, and it's going to be increasing to about 75% in 2024, with this decline in AFFO of about 16% for 2023 and another 5% almost in 2024 estimated. So some opportunities perhaps here, but there's still that quite a strong softening here then of the AFFO estimates. Paramount Group, so price is very, very high relative, I think, to the AFFO, with a normalised AFFO ratio of 30 times. Dividend yield 6.4%, long-term debt to capital ratio of 50%. Analysts do a pretty bad job 1 year forward estimates, and again, not a great job 2 year forward estimates, so take it with a grain of salt. There's not a lot of analysts following it here. Only 4 providing estimates to the end of 2023. If prices were to return to such an elevated price to AFFO ratio, it would be quite an extreme increase in prices to the end of 2023. If the prices hit a 15 times price to AFFO ratio by the end of 2023, we could talk about a 115% annualized rate of return here, with quite a steep increase would be expected, but we can also see quite a strong softening here of the AFFO projections over the 2023 year, and so analysts have been projecting downwards over the last 6 months. The dividend yield dividends are supposed to be held constant, or estimated to held constant, so the dividend payout ratio will be slightly higher in 2023, but still quite a manageable 53% here. Postal Realty, PSTL, so 22 times price to earnings, price to AFFO ratio has been fairly normal. Good 6.5% dividend yield, reasonable long-term debt to capital ratio of 47%. Not a lot of history here, so the analysts have been hitting it bang on. The forecasting calculator then, moving forward, if they can return to 22 times price to AFFO ratio, I think that's reasonably unlikely. I'm going to bring this down, I think, to a reasonable here 18 times, given that I don't think that 22 times is all that reasonable. Having said that, the nature of the business, it's going to be quite stable, it's going to be quite secure, so it could be deserving of a reasonable premium. I'm just not sure 22 times price to AFFO is reasonable here. But look, if they can hit 18 times by the end of 2024, prices can return to that level. We're talking about total annualized rate of return of 22%. Unlike the other office REITs, we're talking about almost no softening here of the AFFO projections in 2023 or 2024. And we're also talking about some small estimated increases in the dividends for each of these years. So a much more stable, reasonable company here than the other office, and I think that's down to their core tenants here and their focus on a very, very niche postal sector, and that sort of security of a very constant tenant here. Now, could they return to 22 times? Well, the answer is, I guess, yes. And if they did, we're talking about some fairly substantial rate of returns here of 36% per year. But note also that the estimated dividend payout ratio is running hot at about 90% in 2022, about 95% in 2023, and again about 95% in 2024. So not a lot of room for error here, but again also quite a stable and constant and very predictable I think office REIT here option. SL Green Realty Corp, so again price decreases here, dividend yields quite high, 10.9% at the moment, BB plus S&P credit rating, relatively high long-term debt to capital ratio here. Analysts don't do a fantastic job either on 1 year or 2 year forward estimates, and we'll take it with a grain of salt then. But we can also see some pretty steady decreases here in AFFO projections in 2023. So AFFO is projected to decline 30%, then be a bit more constant. And we're seeing an estimated decline here also in dividends. I would say even at that level, it would still leave us with a dividend payout ratio of over 100%, so that might even decline further. Now, what's driving the price and declines and the AFFO overall AFFO estimate declines is a strong decrease here over the last 6 months of the AFFO projections from analysts. Now, if prices could return then to that sort of 16 times over the next year and a half or so, we're talking about a total annualized rate of returns here of about 40%. But again, be careful about these strong AFFO declines. So have a look at SL Green Realty Corp. I think from memory this might be a New York focused. So we're talking about sort of big city REITs. And again, take it here with great caution and care, where analysts are expecting a very strong decline here in AFFO. Vornado Realty Trust, VNO, again price declines, but we can also see here AFFO declines are expected going forward. The white line here showing dividend levels has been choppy, jumping all around the place, but currently paying about an 8.7% dividend yield, BBB- credit rated, 58% long-term debt to capital. Analysts don't do a particularly good job here. Half the time they get it right 2 years forward, and they get it wrong 42% of the time 1 year forward. Now, what does that mean? Well, it means that, as we've seen in many other office REITs, we've seen estimated decreases here for AFFO, 17% in 2023 and a further 7% in 2024 year. And again, quite a strong softening in the AFFO estimates over the last 6 months from those analysts. If prices return here to a 19 times price to AFFO ratio by the end of 2024, you're talking about a 55% total annualized rate of return level. Now, noting here as well that the dividends are estimated to decrease, and that would actually leave us, I think, with a fairly healthy estimated dividend payout ratio of about 70 to 80%, low 80% in 2024, which seems reasonable here. Whereas residential, so AFFO levels have been declining over the last decade. Reasonably elevated long-term debt to capital ratio. Dividends have been ceased over the last couple of years. Forecasting calculator doesn't work particularly well here, but we're talking about only a couple of analysts following the REIT. Prices are relatively elevated here compared to AFFO, so even though there's expected to be strong AFFO level growth, the prices at this point suggest that this is probably not an investment where you'll be potentially making money, simply because prices are so elevated now relative to where AFFO might be in a couple of years' time. Okay, so where does that leave us? If you're really into the office REITs and you're looking for candidates for further research, I personally will be looking more at Cousins Properties, CUZ, and Alexandria Real Estate, ARE. I think perhaps if you're looking to take on a little bit more risk, I think Highwoods Properties, HIW, or Hudson Pacific, HPP might be other options, but I think Alexandria Real Estate, being in the lab space, into the healthcare sector, into the life sciences, I think that's one. It's got a lower starting yield, but it's got, I think, better long-term growth prospects and more stability than many of the other options in the office REITs. What do you think? Hit me up in the comments box down below. What are you looking at in the offices, in the office REIT sector? What are you most interested in? What are your thoughts on these companies? What are you interested in investigating and researching further? Don't forget to hit the thumbs up button. Don't forget to hit the subscribe button as well, and I'll see you in the next video.